Hello and welcome to this panel session where we will be discussing how the asset management industry can contribute to build back better, build a more sustainable, inclusive society, and contribute to a durable and resilient economic recovery from the COVID-19 crisis. First of all, I'd like to remind the audience that all the sessions will be available on demand for 2 months at crossborder.live.ft.com. Also, please head over to the sponsor page to visit the sponsors hubs, and please share your thoughts on social media using the hashtags crossborderLU and crossborder2021. Now I'm delighted to introduce my panelists, who I'm sure will provide a variety of perspectives on this theme of ESG investing. We have Hortense Bioy, Director, Sustainability Research, EMEA and APAC at Morningstar. Hello, Hortense, how are you?
Hi, I'm good, thank you.
And then Jessica Ground, Global Head of ESG Capital Group. Welcome back, Jessica.
Thank you.
Charlotte Thorne, Founding Partner at Capital Generation Partners. Hello, Charlotte.
Hi, Lisa.
And then Andrew Jamieson, Global Head of ETF Product at Citi Group. Hello, Andrew.
Good afternoon.
I would like to remind our viewers to submit questions for our panelists through the chat box to the right of the screen. We look forward to receiving them, and our speakers will be answering your questions in the last 10 minutes of this session. So let's start our conversation. Hortense, if I may start with you, one of the very few silver linings to the dark cloud of COVID-19 is that the pandemic accelerated investors' interest in ESG issues, and this interest is likely to intensify in 2021. So why do you think the role of asset managers and owners is so crucial in addressing environmental challenges and building a more sustainable society? Can the asset management industry make a big difference in filling the funding gap to reach some of the UN Sustainable Development Goals?
Yes, I think, of course, asset managers and asset owners have a big role to play. I'd like to focus on asset managers because they, as we know, they all say that, I mean, most of them say that ESG is now central to the way they think about investment. ESG risk represent ESG factors represent investment risks. But that's only through this lens most of the time that they look at issues like climate change, and I don't think they're necessarily looking to build a more sustainable society for the sake of it. It's just that because they realize that it's become material to the client's investment return. So it's really from a risk perspective, they really consider ESG factors. Now, some asset managers are going beyond that, and they're really thinking about building a better future for people who are going to retire in 30, 40 years time, and they focus more on impact. And I think this is where the discussion is now probably going. The EU regulator is certainly pushing asset managers towards this type of discussion with the disclosure of adverse principal impact. So I think, yes, asset managers have a big role to play because there is also investor demand. We're seeing where the money is going now. The money is certainly flowing into those that to either mitigate ESG risk to a greater extent than conventional funds, or they are more aligned with investor values, or they are focusing on a more sustainable theme, like climate, for example.
We can talk about the different approaches a bit later. But looking at increasing flows into ESG strategies, Jessica, why is it so important to have so much money going into these strategies? What kind of virtual circle does it generate, do you think?
That's such a great question, and I think in changing the fund flows, I think that the asset owners, so what Hortense was saying, are explicitly signaling that they're longer term. There was quite a lot of criticism after the last crisis we had, the great financial crisis, that the markets had become too short term, perhaps just interested in, trading and things like that. And one of the things that I take about the flows into sustainability is actually it's quite an effective mechanism for asset owners to signal that they are really thinking about the longer term impacts. And sometimes the longer term impacts aren't just a series of shorter term impacts bootstrapped over time. And that they're explicitly saying actually issues like climate change, like inequality, could impact longer term investment returns. We don't quite know how, and we really want you to think about that and make sure you're well positioned. So I don't think we should think of it less as sort of should I buy this green bond, as that signal about really how do I consider all of these risks in a portfolio and make sure that I'm positioned sort of accordingly.
While there has been a prolific increase in the number of funds which have explicit ESG objectives, Charlo, we are increasingly seeing funds which are not mandated to follow a responsible investment process, but are nonetheless integrating ESG as a hygiene factor. So we talked before about in recognition of the positive impact it can have on corporate performance and risk mitigation. So do you think ESG is more a hygiene factor or an active selling point for clients today? What is your experience at your firm?
Yeah, thanks, Elisa. Sorry, was that for me?
Yes.
don't want to talk across someone. Yes. Well, at Capital Generation Partners, we are responsible for allocating capital of ultra high net worth clients. So I suppose that's my role on the panel, to talk about what they are looking for. There has absolutely been a shift towards looking for places to allocate capital which have ESG as a hygiene factor within it. But I think we're used to talking about hygiene factors as something that's not of interest, as something sort of in the back room which just has to be dealt with. They're hygiene factors in that they need to be universal, but they're more important to our clients than that. And I would just echo something that Jessica said, which is that for most of our clients, they're very long-term investors. So for them, this is a way of making sure that they are positioning themselves well over the very, very long term. There's often an intergenerational aspect to their wealth. There'll be a transition of wealth. There's as well that there's an important factor that ESG can play in connecting generations. That's important in our space. But I think just as investments in and of themselves, yes, there's a hygiene factor, but it's also this point about being a very long-term investment. I think how we are talking about this with our clients is that we are in the process of really major retooling of the economy, akin to another industrial revolution, and that's of interest to investors. So I think many of our clients, who may not necessarily be the most expert and most knowledgeable around, perhaps environmental factors, recognize, a long-term tipping point shift when they see one, and that's where we come in, and that's also where we're very dependent on an industry providing us with the products that we need to allocate our clients' capital to.
And talking about products, Andrew, active funds account for the large majority of assets under management in sustainable funds, but ESG ETFs nearly tripled assets in 2020 and continued their growth streak in January, rising by more than 11%. So what drove the rapid growth of ETFs last year? And do you think that 2020 was a long-awaited turning point for ESG ETFs?
Well, look, I think ETFs are often viewed as a barometer of investor sentiment, and they offer a broad range of precision exposures and flexibility in use case. So consequently, they have become more and more the vehicle of choice for large institutional investors. And, last year was no different. And in fact, we saw another record year in Europe of inflows of over 100 billion, take AUM over 1.2 trillion. And in the US, which is obviously a bigger market again, we gathered more than $500 billion in new ETF assets. But, to put things into context, by the end of November, the allocation to ESG funds within the ETF complex had jumped from 3.5% to 7.5%. So, clearly there's still a long way to go, but it is having a significant impact. And what we're seeing really is people looking at what we call core replacement. So if you look at the opportunity that was afforded through the fallout of the initial COVID pandemic sort of market turbulence, people were churning over their portfolios. They were moving out of traditional asset allocation. And when they were coming back and putting that risk on again, they were looking at ESG flavored variants of the same types of products. So there's definitely a very, very seismic shift into looking at ESG, particularly within the ETF marketplace.
Do you see any key advantage of ESG ETF over active mutual funds, Andrew?
Well, I think, the key thing again here is just the ETFs are a wrapper. So it's not, again, a case of passive versus active. Effectively, you should think of them as one and the same. Clearly, there are some benefits the ETFs possess in terms of transparency, in terms of intraday liquidity. As I mentioned, that's why we are seeing them in more and more being used by the largest sort of institutional players. And I think really what we're seeing is the adoption of thematic investing. That's really been where we've seen these sort of precision exposures. And the barriers to entry for the ETF industry are relatively low. So people can launch products and equally don't have that fear to close down products that aren't resonating with the audience. So, I firmly see ESG as the big battleground for the ETF issuer community in 2021. And it's going to be quite exciting.
Yes, we can talk about thematic investing a bit later. But Hortense, looking at the movement towards multi-stakeholder capitalism, do you think that asset managers are realizing increasingly they've got to be accountable for benefiting stakeholders and drive change? Where can you see this movement in the asset management industry?
Yes, I mean, I guess there are many ways they can drive change and be held accountable for the money that will flow into products that will benefit all stakeholders. I think I can talk about engagement, investment stewardship, which I think is becoming more and more clearly is becoming a strategy that more asset managers are keen to adopt when it comes to affecting change, and that's at the same time. So we're seeing asset managers talking more and more about the engagement activities, and it's clear they've increased their investment stewardship teams. They're asking the portfolio managers to engage more with companies, not only to collect better data, better information about this, but also to influence them and to share knowledge of what.
Hortense, do you think this trend for firms to make very public demands for ESG practices may be just a marketing ploy, kind of a box-ticking exercise, given that most asset management firms are not actually integrating ESG themselves, so they are not practicing what they preach? What's the risk there?
Well, there is a clear reputational risk there. Obviously, they can't be asking companies to improve the ESG disclosure and not themselves disclose the information, or not making the progress that they ask the investing companies to make. So yeah, there is a clear reputational risk there. I mean, we're seeing more and more asset managers making commitments, which we welcome, which this is very good, but they will have to to walk the talk, and through the voting, or be more transparent about the engagement activities. Investors now, what they want to see also from asset managers is probably more concrete actions and more targets. So it's well to see. It's well to say, we are focusing on these issues, but at the same time, investors want to the asset managers to set some targets for companies and milestones. And if those companies do not meet those targets and milestones, then there has to be consequences, which would be, for example, voting against the re-election of board directors, or even exiting the company if really they see no progress, where they've asked the companies to make progress.
Mm-hmm. And Jessica, on this topic, one of the most powerful tools asset managers have to drive behavioral change of investee companies is shareholder voting. But do you think the asset management industry, asset managers are making the most of this opportunity? Because there are so many examples of asset management firms that are actually not voting to reflect their statements about wanting to hold climate critical companies accountable, for example, to undertaking urgent transformations.
Yep. I mean, I think, one of the things I'd comment is that, voting is a sort of very public part of stewardship, and underneath that there are loads and loads of meetings. So just for context, at Capital Group, we voted at about 2,000 AGMs, and underneath that we had 20,000 meetings with companies. So you can see it's a small part of the interactions that we have with companies. So that's one thing. I think the other thing is that there's a lot of focus on voting on E&S proposals, and we've seen a dramatic rise in them. And of course, there's a wide range. There's a wide range of these. I think, a lot of the transparency that's been provided by things like the Shareholder Rights Directive is starting to sort of focus the mind on, well, prove it, and we're going to look at the voting. And I'd also really speak to what Hortense was saying, is actually, if you say that engagement is a sharper tool, can you please tell us what's happening in these conversations and what's coming out of those? And that's one of the reasons why, at Capital, we are going to be reporting against the new UK Stewardship Code requirements, which are quite demanding, and we need to talk about progress and we need to talk about outcomes. So voting is kind of a small portion of our interactions. We can realize its uses, but we also think there's a real benefit to sort of talking more about some of the conversations and where we're getting progress and how we're using engagement. Because I think another thing that I thought Hortense said very well, which is, it's a bit like we're at the show me part of this debate. We can see it makes sense. We can see it's necessary. So come on, show us what that means. And that's what we're sort of committed to providing more transparency on.
Mm-hmm. And Charlotte, do you see that your clients, sophisticated investors, family offices, are increasingly looking for bespoke solutions in the sustainable investing space? How do you meet their demand for bespoke solutions?
Yeah, they're very much on a spectrum of, some of them have always had negative screens and are actually moving towards something more sort of holistic. Others are treating it as a hygiene factor. Others have very particular areas that they're concerned about, that they want us to reflect in their portfolios. We're helped in this by the fact that the industry, the asset management industry, is based around product manufacture. So there is a proliferation of funds. Sometimes that's unhelpful, but there's also positive in there as well, because if you've got the right advisors in place, you can sort of weed through the bits that are, frankly, there is greenwashing. We all know it. You can weed through that and you can find the piece that's particularly relevant to your interest. Just to give you an example, I mean, we do make use of ETFs, and I think Andrew's right that they will some of these ESG ETFs will become the core replacement, but we also use active funds quite heavily. And we had one fund come to our attention which had, they called it a sort of socially responsible version, share class of their main fund. But what that meant when you looked under the bonnet of it was, because their main investors were either Midwest American or Middle Eastern sovereign wealth funds, there were no investments in anything deemed to be anti-family, by which they meant sort of contraception, for example. So I think for most people, that isn't what they would mean by socially responsible investing. These terms cover a huge array of ideas underneath them. Some of them are sort of wild and wacky. Some of them are serious and sensible and data driven. And it's the job of clients, advisors, and the asset management industry to be clear, communicating well, what each product does for each individual client. And it's true, certainly in my part of the industry, that no two clients have got the same set of emotional connections and needs when it comes to ESG. So although the proliferation of product can be a problem, in a funny way, it's also helpful to us in helping us build something completely bespoke. What I think in each case, what it does, setting aside the worst of the greenwashing, in each case, what it does is provide greater choice to the client, more mindfulness around selection of what's the underlying in each fund. And for us, that gives us a sort of a more of a subtle palette to work with when we're building portfolios.
Mm-hmm, mm-hmm. And Andrew, if I may bring you in here, so as Charlotte was saying, ESG is a topic that is quite subjective, very personal. So what ESG means to one person may not be the same as it does to another. So how, when building ETFs, building ESG ETFs, how can index providers take this into account? Is there a way to do this?
Sure. I mean, I was just actually chuckling to myself on the previous point, and maybe if I could just make a point on that whole concept of voting. It has to be probably one of the least ESG-friendly processes on the planet, the deforestation that takes place in the proxy voting system. I think I'm right in saying it is either the second largest or largest client to the United States. And yet, there are digital and transparent alternatives. There are platforms like Proximity that we're speaking to a lot of ETF issuers about to try and give that digitalized, automated, transparent voting opportunity, as opposed to posting huge rafts of paper around the globe. So certainly something for the industry to think about as we're on this ESG topic. In terms of your question on the disparate landscape of ESG, clearly there are a lot of data providers out there. I think there's about 80 different sources currently. It's driven very much on ratings, and yet we have to kind of try and move beyond ratings and think more about the individual E, S, and G factors. I do believe there are efforts afoot to try and create some standardization, but at the same time, where there is challenge, there is also opportunity, and that's to some degree why you're getting all this product proliferation, because hopefully, if asset managers are doing their job correctly, they are trying to marry where they can make impact with the end companies that are being invested in, but at the same time satisfying client demand. There's no point bringing out products that people don't want to buy. Rather, if you can bring out products that people want to invest in, then I think you're serving your community as well as you can. So I think it's definitely a challenge. I think in terms of specifically to ETFs, we see it in three distinct buckets currently. We see that very nascent early exclusionary approach, taking blockbuster indices and excluding what are the worst or the easiest to target. We're then seeing that second generational thematic investing, looking at things like clean energy, cloud computing, innovative healthcare as good examples. And then lastly, it's really about moving to that third phase and real impact investing and how you can affect change and be more specific and think about the various prints that are out there, whether they be carbon, water, clean air. These are the kind of things that people really want to invest in to get that market beta, but feel like they're driving positive change.
Mm-hmm, mm-hmm. Jessica, one of the biggest problems in the industry is there is no common reporting or common methodology in the ESG area. So that makes it difficult to compare companies, report the progress in the ESG space and measure it. So how do you overcome this issue, and how do you overcome the issue of lack of disclosure, particularly in emerging markets, for example? So two questions there.
So the first thing is we are sort of committed to improving the system as a whole. So, for example, we've been early and long-standing supporters of the sustainability SASB, Sustainability Accounting Standards Boards, and pulled in a lot of our industry analysts to be experts. So it's very fashionable to kind of talk about the problem. We're definitely committed to being part of the solution. The other things that I have touched on is, really harnessing some of the unconventional data to do this, to track this, and that's really interesting, and that's a big area for investment. And then I think the third thing is, as we've already touched on, is engagement. So, the fact that at Capital our investors are very global, on the ground, really deep relationships. So one, not only are they encouraging them to improve their disclosure, but they're also having these dialogues around things, and then we're capturing that. I also think as well, certainly, we're also involved with groups like the Asian Corporate Governance Association, and, their recent seminar was, all about how we kind of improve sustainability disclosure. And of course, Europe is having a big push around the taxonomy, and we're all going to be reporting principal adverse impacts, as some have already commented on. So there's a lot of activity here that I think will see quite rapid progress in the next couple of years, or failing that, just give me more grey hairs. But I think the industry is committed to trying to overcome this.
Mm-hmm, mm-hmm. Hortense, do you see that, how fast do you expect the harmonization or convergence of standards? Do you think it's important the industry develops global standards, and perhaps EU standards may become global standards?
Yes, I mean, that's such a wish of many investors and also probably companies as well. They wouldn't want to be disclosing so much data just to comply with many different taxonomies, because we know there are many green taxonomies that are being developed across the world. I mean, the EU is obviously leading in that area, but we know that there are also taxonomies in other parts of the world, and that will not be beneficial to anyone to have these different standards, and so we need to bring some convergence. But I think it's going to take some time. As we know, countries have different interests. They have different type of economic activities, so they will they have a vested interest in going at different speed as well. So we'll see in the next few years how that plays out. But at some point we're going to need some convergence, but it's going to take time.
Mm-hmm, mm-hmm. And Charlotte, do you think that with this such staggering growth of funds in the sustainable space, the risk of greenwashing is even greater? Do you think it's really come to the forefront? How difficult is it to untangle slick marketing collateral from the actual investment proposition?
I think it can be difficult for the investor on the street. Our industry is very, very good at marketing, and that's not always to the advantage of the underlying client. I mean, I know we're all on the call wanting an industry that does does better. I include the whole industry in that. This topic, like crypto, like any other topic, will result in product proliferation, and some of those underlying products just won't be very good. We know that. And I think those of us, I count all of us in this, who put our clients' interests first, are committed to making sure that our clients are invested in products that mean something. The issue around data and the lack of a single taxonomy is a challenge. But one of the things that we rely on greatly is knowing our managers. And as Andrew said, I think even where it's an ETF, we want to know, really quite closely what benchmark is being used here. Is it replicatable, for example? How big is the tracking error? Even with an ETF where there isn't an active manager necessarily in place all the time, there are ways for allocators like us to identify, the sheep from the goats. Clearly, as I mentioned, we also make use of active funds, and we're very aware that, for example, one of our funds that we use in almost all of our portfolios is a frontier manager. And they are largely invested in frontier small caps, so most of their underlying assets don't have any coverage at all. But we are very confident in their ESG credentials because qualitatively we know the manager really well. She knows the underlying holdings really well, and her qualitative reporting is just fantastic quality. So there are ways where even if you can't get the data, you can give your clients and yourself a level of reassurance that there really is something valuable here, and that I think applies to ETFs, to active managers, and it's beholden on all of us, I think, to do what we can to help clients identify. There's a big disparity and dispersion between the best performers and the worst, and it's up to all of us to help our clients work out how to navigate that gap.
Mm-hmm, mm-hmm. And a question for the panel, really. This repurposing of existing funds to, which turns them into a sustainable fund. Do you think that is a way to mask kind of ailing portfolios, trying to attract flows to struggling investments? Or is there any other way or any other reason to do that?
Maybe I can talk about this because we're tracking those funds very, very closely. So, there are many reasons why an asset manager would decide to repurpose a conventional fund. And you're right, it could be because some funds are not attracting new flows, so they see that the flows are going into ESG funds, and this is what clients are demanding, then they just change the mandate, so they can change the investment objective, and or they can also change or only change the investment policy by adding some exclusions, or we've seen also funds totally change mandates and managers and they've adopted a thematic approach. So there are many reasons, and most of those funds obviously rebrand because they want to add visibility to themselves and the asset managers. It is a way for asset managers to grow the sustainable fund business, but I wouldn't see that necessarily as a negative thing. We've looked at those funds and the sustainability profile of those funds, and they're very similar. They have a very similar profile as those funds that were launched as ESG products. So there is not. They're not masking anything. It's just an interesting trend. We say that they are greening their assets, and by the way, this is what the regulator wants them to do. So it is fully supported by EU regulation. You either launch products or you repurpose your assets.
Mm-hmm.
I think maybe if I could add, I think there is a slight danger, however, that in chasing that sort of ESG, we start to get some real concentration in the industry, because I think as a whole we think of ESG as being overweight growth stocks, So it's like a heavy tilt towards tech, consumer discretionary communication services, and things that are in this sort of disruptive end of the spectrum. And therefore, you're going to be underweight value sectors like energy, utilities, and materials. And you can't really afford or affect change if you don't own these companies. So there needs to be more done. And I think that was kind of where I was talking about the impact side of things. It's taking a broad approach to the existing diverse landscape and ensuring that they have ESG credentials overlaid, as opposed to just saying we're going to focus on that sort of easy, quick win and have people chasing where they think the flows will naturally emanate early.
I think that's a really good point, and it's one that I can almost identify what might be a problem in building portfolios that incorporate sort of ESG value stocks, for example. It might simply start at the asset allocation end, that, you know, if you've sort of co-located your ESG with your growth allocation, it's going to be hard then for your fund source people to come forward with valuable ideas on the value side. So I think that is a really good point, and I think Andrew is quite right. There isn't a way to build a more sustainable economy without having that whole spectrum of assets retooled, and that will mean some of the really boring assets that have been sort of wholeheartedly ignored over the past 3 years as everybody's piled into the tech stocks.
But there are also, I like to add that there are also strategies that focus on engagement. There are ESG funds. They don't necessarily hold like green companies, but they say the manager think that they have potential to improve the sustainability profile. So I know some investors may look at those funds and look at the holdings and think, okay, this is greenwashing because your portfolio, it looks exactly like a conventional portfolio. Why do you brand it ESG? But the manager is going to say, no, my strategy is to invest in those companies because I think they have potential to improve their ESG profile. And I think it's very important to mention that really it's a spectrum of strategies that we're talking about here. They're not all investing in renewable energies, even though I must admit, you know, when we see the performance of those like very green stocks, yeah, that it could alarm some investors who would think, you know, there's a green bubble out there, and we have to be extremely careful. But not all ESG funds invest in the same companies.
Jessica, is your preference for companies that are transitioning the fastest and the best to a greener economy and contributing to a more sustainable society? So the improvers, which are expected to bring perhaps the greatest returns, or your focus is on identifying firms that are leading in the ESG space and that already have good practices? What's your view here?
I think it's you've got to be really pragmatic, and you've always got to bring valuation into it for us as an active fund manager. So, you know, it's no good investing in a leader if they're sort of priced to perfection and perfect execution, and it's no good investing in a company that you say is going to transition if you never bring it up in a conversation and it just sort of withers away. So, you know, I do think, you know, the thing that I would stress that came out of the conversation is, you know, and Charlotte said it really nicely. Our industry is very good at marketing, and what you need to be doing is getting under the skin. We've talked for more sort of show me, prove it moments, and the need for that. But genuinely, I do think one of the things I would be a little bit aware of, so we've talked about ESG perhaps getting some of the funds that we can see getting quite growthy. I also think there might be a little bit of a risk with the taxonomy that we only have it defined in a couple of narrow sectors, and people are going to be encouraged, you know, that the next question is going to be how taxonomy compliant is your fund. That could potentially cause a little bit of you could definitely see a lot of money going into taxonomy compliant investments to tick that box. So, you know, I think the big thing is that you know, as I said before, we are still at the footholds of this, and you know, there are a number of different tools that you can use, whether it's engagement, thematic investment, you know, a holistic approach on just identifying the more sustainable products. And it's really making sure that whatever somebody says that they're doing, they can just provide the proof points around what they are doing.
Okay, I can see here we already have a few questions from the viewers. So, what impact will Biden rejoining the Paris Agreement have on ESG and climate investment globally? So, what's the impact of Biden administration on sustainable investing? Do you have any strong views, Jessica?
Well, I think if we look at some of the signals on who's sort of being appointed to the SEC, I think there's going to be much more support for companies disclosing more data around how they're handling climate change, and I think that's going to be really helpful. You haven't guessed it before, we're always hungry for more data on this. Just also, you cannot underestimate the power of rejoining Paris, and that commitment to keeping temperatures well below 2 degrees and all the knock-on policy impacts on that. So I think you're just going to see a sort of a period where the where the US kind of plays catch up, it definitely is really interesting. It is already changing some of the conversations and some of the disclosures that we're getting from companies.
And also it is going to create more investment opportunities, which investors are looking for. Like as we just said, we don't want everyone to be investing in the same companies, and especially in the listed market. There is this whole like private market where also investors. Obviously. Not all investors have access to this market, but hopefully that will create other companies and investment opportunities for investors in maybe 5 or 10 years' time.
I think that's right. I think it also it extends the conversation really valuably. One of the things that it does for clients in our space is it actually opens up short opportunities as well. One of the things that we do, for example, is work with hedge funds, many of whom are, really only in the very, very early stages of putting in place anything whatsoever on ESG. Obviously hedge funds traditionally have viewed themselves as outside of all of this regulation. They're structured so that they do fall outside of a lot of this regulation. But we're finding, and the American move is part of this, we're finding that increasingly the hedge fund managers are talking to us and saying, well, what is it that your clients want to see? They're never going to, go hell for leather towards, extreme taxonomy measures. But they're wondering how they can make their fund product a better fit with what clients are looking for today. And the shift in conversation in the States is going to help that. We're never going to see hedge funds, doing all the voting that, perhaps a concentrated active manager will do, have that sort of engagement. Most of them are not able to do that sort of thing, but they are beginning to ask us, what is it clients are looking for, and how can we make changes that would just help us sit better within this sector? And for those of us who are members of UNPRI, we've signed up to UNPRI, and I sometimes think, because we're at so many degrees of separation from the underlying assets, one of the values for the globe in a firm like us signing up for UNPRI is it just in a tiny, tiny way increases the cost of capital for assets that are not ESG friendly. And so, every marginal fund that you move ever so slightly towards taking an ESG approach, I think just ever so slightly increases the cost of capital for non-compliant assets.
Mm-hmm, mm-hmm. So SFDR is due to come into effect in March 2021. And are there any major challenges that asset managers face? Regulation. Some managers I talked to say the requirement to report on ESG targets will be beneficial for data providers, but will drive costs up for asset managers. Do you think this is the case? And also one more question from the audience. Is there any area where regulation can actually improve and support ESG in fund management?
So on SFDR, as you mentioned, March is the deadline. We've only just got the level 2 text on some of the things, so we're still working through it. But undoubtedly, when we're talking about, the reporting on sort of almost 20 principal adverse impacts and some of the sort of much more granular data, I imagine the industry will be leaning in. I think it'll take a while for it to be additive before somebody like Charlotte really, especially looking at the asset manager level, will find this useful. I think it's going to be more useful when it finally comes down to a fund level and sustainability. So there is going to be a huge amount of work until we're all sort of producing those reports. Yes, I suspect we'll be writing bigger checks to the data providers. What is it? In a mining boom, it's the people who make money or the people who sell the picks and the shovels. And that's certainly the case in the ESG boom.
One more question from the audience. Do you think that there is a role for direct indexing? Investors hold ETF positions directly so they can customize the portfolio around ESG.
I mean, it's becoming a big thing in the US, but because of tax advantages, you could get there. But yeah, I can see the attractivity of this approach. And yeah, who knows? I mean, for ESG, obviously it makes total sense because investors can include or exclude the company they want. They're not restricted by the vehicle. But I think it will come later in Europe. Let's see how things develop in the US. Like ETFs, they developed first in the US. They were big in the US. They're still big in the US because they have a tax advantage. In Europe, it's mainly institutional investors who are still using them. But we'll see how also for in direct indexing that plays out.
One question I'd like to ask you is whether you see that the integration of the ESG factors is gradually spreading into asset classes, and which asset classes would you like to see more investment solutions, and what are the challenges of producing solutions in asset classes different from equities?
So I think it's massively increasing in all asset classes, having really, let's be honest, been very equity focused. So fascinating to me is that even when you come to fixed income, there are still a number of challenges. The data is material less good. Even really simple things like issuer hierarchy becomes very complicated. And then trying to get some of the underlying data on sort of structured products is real challenging. But actually, if you look at a lot of the AUM and a lot of the large asset owners in Europe in particular, fixed income is a huge part of that. If you look at some of the insurers in particular, where they're starting to think about sustainability because their regulator is. So even before we go really exotic in asset classes, I still think we can do a much better job in fixed income, and certainly we're spending a lot of time focusing on building the right tools to do that well.
Yeah, I mean, from an ETF
I would.
Oh, sorry. Go ahead.
Charlotte first.
Sorry, I was going to say I would have said fixed income also, but for us also private capital. We're looking for better opportunities in private capital. It's been a bit slower. Some of the opportunities are less well covered than obviously the equity market, but things are shifting. And as I've mentioned already, hedge funds will probably be the last asset class to go. But there are signs even in hedge funds.
Andrew, 10 seconds.
Yeah, sure. No, I was just going to say, we're already witnessing it in the US. The municipals market is suddenly becoming a very ESG-friendly market, something that people didn't necessarily realize early on. So with a universe of so many tickers, there's a huge opportunity in fixed income.
So thank you very much for all your insights. We have run out of time. I would like to thank Charlotte Thorne, Jessica Ground, Andrew Jamieson, and Hortense Bioy for this very thoughtful debate on this very hot topic. I'd like to thank the viewers for your attention and questions. And please stay with us for the next session with Yuri Bender, Editor-in-Chief of Professional Wealth Management, who is chairing a keynote interview on diversity in the investment industry with Shola Mos-Shogbamimu and Georgina Philippou. The interview starts in 10 minutes. Thank you.